Hey everyone! Welcome back to our channel. We often see a lot of paid courses and tutorials teaching traders to recognize those chart patterns, which boast to have a substantially high accuracy rate. Therefore, traders love them. They become one of the most essential references and things to learn for beginners. Today, we are going to find out if these patterns really are as foolproof as they claim to be, or are they just too good to be true. Before we start, you may ask, what are chart patterns? Chart patterns are formations that appear on a price chart of trading assets. Traders have identified commonalities among these patterns and have compiled a set of chart patterns that predict the likelihood of a price movement in the near future. If you have no idea how to identify such patterns, no worries. TradingView now offers a feature that helps identify these patterns. This feature can be accessed through the indicator list. Now, let's pick one chart pattern into the test. We are going to start by talking about one of the most popular chart patterns, the inverse head and shoulders. This pattern claims to have a success rate of 90% in reversing a downtrend, with an average price change of 45% when entering this pattern. The inverse head and shoulders pattern occurs when the price of an asset hits a bottom 3 times, forming two troughs known as the shoulders and a lower trough known as the head. This pattern suggests that the price of the asset may soon start to rise. Is that really the case? Let's take a look at an example on TradingView. On the left side of the chart, the inverse head and shoulders pattern is formed. The market price breaks through the resistance for a few bars but immediately returns within the resistance line. It never reaches the targeted price and even breaks through the support level. However, instead of moving in either direction, the market moves sideways, resulting in losses for traders on both sides. Here's another example on a different time frame. The price fails to break through the resistance level and retraces back to retest the support level. But eventually, it rises back up, causing losses for those who stopped their losses early. And here's an example on Litecoin. This demonstrates that without a good take-profit system, traders will still experience a negative abnormal return with this chart pattern. It is more important to determine when to take wins and losses. With the assistance of the trade dots indicator on the chart, traders can easily avoid buying into patterns that seem too good to be true. Moving on to the next chart pattern, we have the triangle chart patterns, including the descending triangle and ascending triangle. These patterns claim to have a success rate of about 85%, with an average price change of 40%. Descending triangle patterns are formed when one trend line connects a series of lower highs and a second horizontal trend line connects a series of lows. In contrast, ascending triangle patterns are formed with a horizontal line drawn along the swing highs and a rising trend line drawn along the swing lows. Let's investigate the effectiveness of these patterns with an example on Bitcoin. We can see that the price broke out of the resistance, but before reaching the take-profit price, it reverted back and broke through the support level, forcing a stop loss. Without trade dots, traders could never take any profits from this trade. Here's another example on Amazon. The price breaks through the resistance, then retraces back and breaks through the support level, causing losses for traders who did not take profits. This example on C3.ai also demonstrates that the market can experience significant fluctuations, resulting in losses for traders on both sides. It is crucial for traders to be prepared for market changes and react promptly. Lastly, let's talk about the bull flag pattern. This pattern claims to yield an impressive 45% returns with an 85% success rate. The bull flag pattern occurs when the price of a security undergoes a rapid and sharp increase, followed by a consolidation phase where prices consolidate within two parallel trend lines. This pattern indicates that the security's price may soon move in either direction, depending on the breakout's direction. To illustrate this pattern, let's examine an example involving Netflix. The price action adheres to the pattern and reaches the take-profit point. However, the example here on Microsoft showed that there are also times when the price fails to break out and continues to decline until it reaches a triple bottom. This last example on Atom once again highlights the market's unpredictable nature. Relying solely on a single indicator or chart pattern to predict market trends is not advisable. Sometimes, the price may test our stop-loss area before reverting to a reversal pattern. So, can you completely rely on chart patterns to execute trades? Definitely not. But are chart patterns completely useless? Also, no. Chart patterns can be valuable references for making decisions. However, it is more crucial to thoroughly analyze the market based on its current conditions. Utilize multiple indicators and time frames to confirm the market status. Additionally, adopt a systematic approach to trading, always implementing stop-loss and take-profit levels when the price aligns. Avoid letting emotions dictate your trades and continue to learn and refine a strategy that best suits your trading style. That's all for today's episode of Trade Dots. We hope this video has provided you with valuable insights. Remember, trading is a complex subject, and it's important to approach it with a critical mindset. Stay tuned for more trading tips from Trade Dots. Happy trading!